Good morning. Today is June 17th, and this is our weekly strategy call with our internal team here at Zacks Professional Services. And on my screen right now, we're looking at the current market action in Advisor Tools. And I just wanted to circle back. This is still a theme that we see day in and day out. Over the last week, we've had some fairly volatile markets. And, today specifically, when we see the Dow, the S&P down, and the NASDAQ soaring, not only are our core equity tilts soaring right along with the NASDAQ, but if you take a look at our leadership sectors in the earnings certain portfolio, they're all in the green today. Communication services is green, consumer discretionary is green, staples are green. Healthcare, another core for earnings certain, is green. Technology is green. And all of the tilt sectors that we recommend not being present in core, only being present for tilts, those are all red. Again, energy, financials, real estate. These are your leadership groups on the downside. Utilities, again. We saw an attempt at a value rotation last week with a sell-off and a recovery, and these repeated attempts at value rotations continue to break down, and that includes the small cap play as well. So the small caps have obviously made some ground, and financials have too, and you can actually see it in the 52-week close range here of the actual ETFs. But just to give everybody a little bit more of a flavor for what happened last week, and again, I'm just trying to put these strategy sessions within the context of what all of our clients and their clients are seeing in the press, specifically Wall Street Journal, CNBC, and any of the other news outlets. These are basically all of the broad asset classes. And this is basically a summary out of the Wall Street Journal of the winners and losers from last week. And you'll see that anything that was around zero, in other words, didn't change for the week. I had to fold up the newspaper article to fit it all on one scan. But where I was going with this is we had a massive sell-off last week. And I think it was one of the worst weeks since March last week. And what I wanted everyone to see was the mantra that we keep speaking, which is these tilt sectors. Your S&P 500 financials were down 9%. Your energy sector was down 11%. Avoiding these types of, value traps is what really helps to preserve client capital. And this is really what our advisor customers are looking for, is stability. So we keep going back to this concept of earnings stability. Even the small caps slipped somewhere in the neighborhood of 9.66% last week, and I think they're even down again today, with the NASDAQ almost up 0.75 of a point. So a lot of things happened this past week. Obviously, retail sales yesterday made a record recovery for the month. It was almost to be expected, but it was certainly above forecast. It was really nice to see. It definitely helps support some of these valuations that we're seeing now. The Federal Reserve was in play probably 2 or more times last week that I can recall, and even earlier this week. The Fed put a cap on the Treasury yields. Again, this is definitely not good for financials. Again, for financials, we want to see, positively sloped, steeper type yield curves with spreads across the various tranches, widening. And, we're just not seeing that to the extent where banks can actually make a fair net interest margin. So, at this point with some of the Fed action, if the yield curve doesn't improve, I'd really start looking for some dividend cuts in the financial space, and that's obviously not going to be good for equity valuations in general. And also the Fed stepping in with the corporate bond buying. I think that was Monday, and I think that pretty much led to a 700-point reversal in the Dow, and so that was a pretty epic move. So let's move on to the next article that I cut out, which was one that I am absolutely thrilled to see somebody talking about, was that we actually have it in print, not just me on a podium saying, hey, utilities led, the downturn in the pandemic. Yeah, I mean, utilities were one of the worst performing sectors in the height of the pandemic, and something that most institutional investors and even wealth managers didn't expect, something that we've been calling for since 2013. I suggested time and time again that equity risk premium was a huge driver of why this utility sector has become so overvalued. And unfortunately, the author of this article and whoever the analysts were that were interviewed, I think they really missed the mark. They were basically pointing to the fact that it was based on expectations of power demand on the decline during this pandemic. And like I've talked to everyone about before, I don't really see it like that. And I guess the reason that I don't see it like that is because I just look at the tea leaves and I look at the charts. And so what we're going to do now is we're going to step into the Zacks Research System, again, the institutional platform, and we're going to look at the equal weighted average utility company in the S&P 500. So this is using our composite facility. And effectively, again, what we're doing is we're just bottom-up reconstructing all of the S&P 500 utility names into a single stocks, if you will, a single stock, so that we can actually do our valuation work. And what I want everybody to pay attention to is this precipitous PE multiple expansion that's more or less taken place since 2013. Again, as far as power demand slippage, if you look at the forecast estimates here, I just don't see it. I mean, for the equal weighted average utility company in the S&P 500, I mean, we've still got a solid trajectory. In fact, an upward slope, 4%, 6% to 7%, in terms of actual earnings per share growth. What I am really interested in, though, is what I commented here was this massive multiple contraction that we experienced in the utility space. So what I want to do is I want to use a pitch book to analyze this a little bit more. I do want to comment, too, one of the things I love to look at on a 20-year chart, right mouse click history, just making sure my chart's at 20 years, is to just snap kind of a least squares trend rate up here. And again, this just kind of gives me a baseline for growth expectations. I can see that we've grown at 2.97% growth annually over the last 20 years. And I've got a yield of about 3.5%. And this is literally just kind of baselining my compass in terms of valuation. Because where we're going to go now is we're going to flip on through our pitch book, and these are just a collection of my favorite views. So I actually set up an actual pitch book for today's strategy call, called the weekly strategy call. And we started out, obviously, with the valuation model. Now we're just going to bump into a PE F12M, and I'll go ahead and save this. And the very first thing that we're going to take a look at is how this valuation stacks up. And I'm going to, for scaling purposes, obviously Apple here in the dot-com era, PE in excess of 100 with perhaps negative earnings or really small earnings. I don't remember what the scenario was, is throwing off our scaling. So let's just take a look at, 10 years. What I really want to do is just focus in on this fact right here. And this should basically set everyone back in their chair. I don't know about you, but can you imagine paying, in terms of a forward multiple, the same for Apple as you would a utility company? That is just an example of how these PE multiples have just absolutely exploded. And you can see from 2013, currently, even with the correction, we're still sitting in a PE multiple on the equal weighted average utility of 18.29. We peaked out at a multiple of 21. Notice we were tracking right along with Apple. It's just incredible how expensive the utility sector got. And this is literally investors chasing yield, because we know that the equal weighted average utility company has only grown 3%. So if I put Apple in here, and I go back to the valuation model, and I were to throw in a least squares fit on the growth of Apple's underlying earnings, I'm at 32%. And I mean, that warrants a PE multiple, that we saw, whatever it was, 22, whatever it was. But 3% on utility growth, getting the same PE as Apple. This is why it's super important to use equal weighted composites, to take away cap biases in all of your relative analysis work so that you can just baseline your scenario down to what is the norm, okay? And we're talking about tremendous PE multiple expansion for virtually no growth. So the question you have to ask yourself as an investor here is, how much is a dividend yield really worth? Are you really willing to trade, 10, 20, 25% growth for, a nominal growth of 2.97%? Because that's really all you're going to get long-term out of a utility. So that's the idea. And the plot actually thickens. If I go back to my PE chart, you can look at this utility sector relative to the broader market, and you can see that, this wasn't something that happened overnight. The writing was all over the wall. We started getting this divergence in valuations really making headlines here back in 2018, although nobody talked about it. You can see the utility sector trading at a massive premium relative to the S&P 500. And the idea here, and we see this, throughout its history, that these two will always come back to parity. It's just, is it going to be the utility sector that collapses, or is it going to be the broader market that plays catch up in terms of valuations? And in terms of the pandemic, it was obviously the utility sector that collapsed. And to take this one step further, you'll note that prior to the actual estimates going into trough, because we're in a recession now, keep in mind this is a PE F12M, and I can mitigate this spike in PE because of the earnings trough by actually going in and putting an F2 PE. So I don't have it in my pitch book, so I can just run down here and grab it. You can see that PE actually comes down a little bit closer. But the idea, going back again to this article that this Wall Street Journal author wrote about an expected earnings, decline because power consumption demand was going to go down. We didn't see it. PEs don't obviously reflect it, or we'd have a spike like we do the SP5. So let's just take a look at that again, just so everybody can see what I'm talking about. So again, earnings, following the normalized earnings trend really, really well, not a trough. But again, if I throw the SP5 up here like I have in my symbol monitor, you can see the reason why we're getting that spike is in F12M earnings hitting this low point gives you a multiple expansion that's really not real. And so, utilities, if you look at the actual trend chart on the PE side, even though utilities have corrected, and again, I'm going to just go ahead and put the SP5 utility sector back in here. Keep in mind that we're still trading above its median over the last 15 years. Its median is a 15.6, and we're at an 18.2. There's so many better options than the utilities. And the earnings certain dividend aristocrats portfolio that I made mention of, I believe, last week, the portfolio is available, is literally a portfolio full of stocks that are better than your average utility company. And it gives you that downside protection. It gives you that diversification that the utilities really no longer give you. And that's really what that article was about, is that, investors were kind of caught off guard, is the fact that utilities in general are no longer a safe haven play. And so what I want to do with everyone now is talk about another earnings certain name that was in the news this week, and one that is an absolutely spectacular bargain right now. is also a member of the earnings certain portfolio, the earnings certain admiral portfolio, and is a member of the earnings certain dividend aristocrat portfolio, and that is Smuckers. Okay, so let's take a look at Smuckers. And I guess to get everybody excited, the very first thing I'm going to do is just throw symbol SJM up here in the symbol monitor, and let's just look at this PE. And wow, I mean, has Smuckers gotten cheap? And look at this yield. Okay, so Smuckers is trading at a forward multiple of 13. We know what the S&P is. We also know that that's inflated. So let me actually taper that down a little bit. Now, you know what I'm going to do? I'm going to bring this FY2 PE back. Keep in mind, we're doing this live. Here's our PE FY2. And so we taper it down a little bit. But we're still, really, really undervalued relative to the broader market. And we've got a tremendous yield. So let's kind of do an apples to apples comparison here. If you could consider Smuckers a utility, they are one of the largest packaged coffee producers in America. They actually supply, I think it's Folgers, MJB. They supply McDonald's with their coffee. I mean, it's incredible. But let's look at this as an alternative to, one of your equal weighted average utility names. So I'm just going to put the compare versus as utilities. And boy, I mean, in terms of valuation, if I was going to do a naive look, I certainly like where this is headed. I mean, I've got a yield that's almost equivalent to what I would expect out of a utility, and I've got a PE that is just absolutely spectacular. So the article that I clipped out of the Wall Street Journal hit this week. Anytime I see something like this in the journal, I always run through and do a quick and dirty 3-minute analysis in DRS. And that's kind of what I'm sharing with you guys. But they're basically talking about widening the range of guidance, and they're also talking about companies that have also basically just pulled their guidance. And it's interesting that McCormick and Hershey's and others are mentioned in this article, and they're all part of the earnings certain portfolio. I mean, I don't know, it's kind of coincidental, it's kind of funny. But let's take this maybe one step further, and I want to talk a little bit about this multiple compression that you see starting in 2013. So 2013, we kind of hit peak PE. We really hit peak around 15, 16, and then we compress. And I want everybody to see what this multiple compression looks like on a price and earnings chart, because this is your classic buy indicator. If I go into the pitch book that I created, I'm just going to go back into valuation model. And what I want you to see, I like to call this a valuation catch-up. Blue line is price. I said 13 because effectively we're trading at the same price for Smuckers that we did in 13, but our earnings have actually probably doubled or better. And this is the valuation catch-up scenario that I love to see as an investor. So when you look at the distance between your orange earnings line and your blue line here, you can see a PE multiple that is much larger than the distance between these two lines. This multiple compression was not driven by a decline in price. Price is effectively flat over the last 7 years. But what's happened is earnings have actually grown into price. Now we've got a potentially explosive breakout scenario here where we know Smuckers is an earnings certain name, and we're going to get back to these multiples at some point. Okay? So the other thing that I love about Smuckers is if I put my 20-year chart up here, same thing that we did for the utility sector, if I do a least squares fit to this trend line of earnings, I've got 10% growth on a 3.25% yield with multiple compression taking place over the last 7 years. This is an earnings certain stock that I definitely want to own, right? And the reason why is if I go back to my utility sector and I'm looking for yield as an alternative to a utility company, boy, I sure like 10% growth better than 3% growth with almost the same yield on average, okay? So this is the type of thought process that everybody kind of needs to be engaged with when they see these articles. A quick 3-minute top through, you know, 4 or 5 of my favorite views in the Zacks Research System can really, you know, do it justice. Let's again take a look at this equity risk premium scenario, and we'll see exactly what needed to trigger kind of the collapse in utility valuations. Back in 2013, when this equity risk premium started to actually slide is when utility valuation should have followed, and it just didn't happen. And now we see this massive correction. So whether or not people start actually focusing on the more aristocratic, you know, non-utility type dividend names will basically be the driver of what happens to this utility valuation. And that's definitely something that we want to pay attention to. Okay, what I want to do, we got a few minutes left. I want to shift focus here on 2 reopening stories. We've heard a lot about the reopening scenarios here in the news, and we've had reopening rallies. And we've had one of my favorite names, personally, my second largest portfolio holding across all my personal accounts, is Starbucks. And Starbucks has been largely not participating in any reopening rallies, and I think this is a huge mistake. I think that this is a huge oversight by the broader market, and here's why. Starbucks did an absolutely spectacular thing during the height of the pandemic. We all know they closed their stores, which wasn't the greatest thing in my opinion, but what they did do that was absolutely brilliant was they took that time and analyzed all of their sales data, literally went through all their receipts, and they determined that 80% of their revenues were driven by to-go business, right? So while they're renegotiating all of their leases in some of these larger cities like Chicago, New York, San Francisco, LA, etc., they're also reevaluating and planning to accelerate a change in the footprint of their stores and kind of go along with the Luckin Coffee model, which is these, you know, smaller kiosk type stores where you just walk up and grab your mobile order and go. Look, here's what happens in this scenario, and this is the real, you know, the summary story here. If you go to the valuation model for Starbucks, this is the same scenario we see with the broader market, we see with value stocks in general, is that we've got this earnings trough. We see it with Caterpillar, we see it with, I've shown this before, and we can certainly go deeper. I don't have time to do it today. But I'm going to default the valuation model here to the F12M fulcrum, and then we're going to actually shift the earnings line to what I continue to stress is more normalized. You can see that this is definitely not normal. But the idea here is that the buy side is looking through the trough. We already know that. And what we're going to do is we're going to try to quantify what the implied valuation for Starbucks looks like. So what I'm going to do is I'm going to actually go out to my F24M earnings point, which is this green dot, and I'm going to line it up with my forecast estimates. And what I'm going to do at that point is I'm going to change the slope to bring this current model return to 0, because right now, if I was only going to grow at 9.4%, I'd be looking at a current model return of like -10. So I got to bring this up a little bit and see that basically my market implied growth rate, and I can actually snap it to that, is about 10.6%. And what I want everyone to see here is 2 things. At 10.6% growth, Starbucks will basically be at about $85 in a year, okay? That's not the real story. The real story is that Starbucks never really traded at a 10% market implied growth rate. As a matter of fact, the only time I ever saw a 10% market implied growth rate was back here in 08, 09. Starbucks always trades at around a 12 to 13% growth rate. So I'm going to increase the slope of this growth assumption to say a 12.5% growth rate. Now I'm looking at a Starbucks of $103 next year. This is why it's my second largest holding, because what's going to happen with Starbucks, and what you guys want to keep your eye on, is this. the margins, okay? If Starbucks goes and renegotiates a bunch of their leases, I don't know what happened. Hold on a second. I think I hit the wrong chart. They're going to save money. If they close down, obviously, some of their non-performing stores in favor of others and other formats that are making more money, then we're going to start to really focus on bringing this operating margin up. At the same time, we're going to bring this revenue number back up. So here's the play that I'm looking at, right? It's a margin play. We know that revenues are going to collapse, right? We know that net margins are going to collapse. But we also know that Starbucks is making huge strides in a turnaround right now. And when they do this, they are going to greatly improve their operational efficiencies. And when you bump operating margin in conjunction with revenue growth, you're literally leveraging or adding, massive amounts of fuel to the net margins. And so you're really going to see some perhaps really nice price appreciation in Starbucks over the next year or so as they start to execute on this strategy as soon as we start seeing results. So obviously, this is the margin analysis absolute. It's actually a custom chart. If you go down here to custom, and it's under the Zacks default templates, there's a bunch of charts in here that I've built out over the years. And it's the margin analysis absolute. I just saved it off in the pitch book. This is going to be a wipeout. But what you want to look for is what happens during the recovery. And my guess is that this margin scenario is going to go to all new highs, which is really going to bode well for Starbucks stock. So hang in there with it. One more that I want to touch on briefly, and again, I'll just show the article very quickly. It was, Disney. And Disney's obviously another earnings certain name, and it's talking about a phased reopening. A little bit different scenario here with Disney. They are obviously going to go through their own struggles, and we already know what those are. I mean, the theme park business is their major headache right now. The important thing to know about Disney is how it, traditionally trades. And what we see here, if we set this to default, a very similar scenario to Starbucks. When you bring this I'm going to say F24M, I'm going to bring that green dot again back up to that normalized earnings trend line and model this. When you look at a least squares trend line for this, it's got a fairly solid 10% market implied growth rate. If you look at the financials on this, and this is something I should have showed you for Starbucks too, if you go to the growth and margin check and you look at the long-term trend, and what ends up happening is the buy side loves to take a look at, the lower of, top side versus bottom side growth. And traditionally speaking, Disney has always traded in a market implied valuation range of around 9 to 11%. And so if we look at the valuation model again, you can see that we're sitting at about 9.5%. So this huge run-up that Disney had, I mean, it was a lot to do with some of the success with, obviously Marvel and the studios, but it was Disney Plus excitement. And Disney Plus is just not that big of a revenue generator for Disney yet. And so if you take a look at, where Disney is channeling right now, it's still within its, price range over the last 5 years. And so it's about fully valued right now until we can get a little bit more clarity about what's going to happen with the theme park. So Starbucks is, clearly an opportunity. Smuckers, definitely an opportunity. Disney has got a really solid valuation. I think a lot of it is still a lot of excitement related to that Disney Plus. So anyway, just to do a quick aside here real quick, throwing Starbucks back up under the growth and margin view, you can see a lot larger long-term least squares trend rate and growth scenario relative to Disney. So, the fact that those two are selling at about the same market implied growth rate right now, Starbucks is definitely going to have a lot more upside potential. And you can see that in its historical growth and its plans for, what it's doing to bring back the business. So I love to focus on the long-term least squares trend rates when I'm doing these types of implied valuation analysis. Is super, super important. Also look at capital structure changes to share dilution and how that's actually impacting diluted versus aggregate growth rates. We can talk more about that in a future strategy session, but I wanted to take the last minute or so and just open it up to anybody that has any questions about anything I've covered today. Anybody have any questions?
Actually, Tim?
Yeah.
Yeah. And of course, you've been speaking a lot about the yield, and of course, real estate has been, or not real estate, utilities, has been the place to go for yield. You know what I mean, over the years. You know, what's your opinion on the other tilt sector? You know, real estate, in the sense of valuation, perspective of yield, or perspective of valuation in REITs?
Yeah, that's a great question. And Adam, I got to be totally honest with you. You know, real estate and REIT investing, you know, that sector in itself is one of the last to recover from a recession. And it can be very, very profitable. I think that if you're very selective in the REIT space, I think that you can do really, really well. You've got to just take a look at that retail exposure and, you know, stick with names like American Tower and some of these that just have no exposure to the retail sector. There's a couple of really interesting REIT names in the marijuana cannabis growth sector that do nothing but own and lease out space to grow cannabis. Those are great. American Tower is probably one of my favorites. But the yield in the real estate sector can be, you know, obviously tremendous, and the opportunities in there can be tremendous too. So I am a fan. It's definitely a tilt. And anybody that has any questions about that, we can take it offline and look at individual names. Any clients or anybody else that see this video want to talk more about that, we certainly can. That was a great question, Adam. Thank you. Anyone else? All right. I'm going to go ahead and end the session for today. Thank you, everyone.